Welcome to Talk Tickers. Today we're diving into Acacia Research, ticker ACTG. And wow, they just dropped a blockbuster third quarter. It looks like the company's big transformation is not just a plan anymore, it's actually happening. So let's break down exactly what went down and what it could mean for the stock.
So, how did the market take the news? Well, they loved it. The stock shot up over 10% on the day, and get this, trading volume was more than 5 times normal. When you see a move like that, it's a huge thumbs up from investors. The big question is, what exactly got everybody so excited?
Well, it all starts right here with a massive beat across the board. I mean, look at this. Revenue came in at almost $60 million, which absolutely shattered what analysts were expecting by more than 50%. And the earnings per share story is even better. Wall Street was bracing for a loss of 14 cents a share. Instead, Acacia delivered a loss of just 1 penny. That's a 93% beat. And it tells you they have a much tighter grip on their operations than anyone thought.
So, how would they pull off numbers like that? Let me tell you, this wasn't some one-time lucky break. No, this is the result of a deliberate, fundamental shift in the whole company. And honestly, that's the real story here. And this chart, this is the heart of that change. You can see manufacturing now makes up over half of the entire business. This comes from their acquisition of a company called Deflecto. It's a complete 180 from their old model of relying on these unpredictable, frankly lumpy intellectual property deals. Now they've got this solid industrial foundation just pumping out cash. And the impact of that shift? It's been dramatic. Just look at this. Revenue is up 155% from the same time last year. That is absolutely explosive. And let's be clear, this isn't just slow and steady organic growth. This is the direct result of their new M&A strategy firing on all cylinders. All right, let's pop the hood for a second. The financial health here looks really solid. They generated $8 million in adjusted EBITDA and nearly $8 million in positive free cash flow, which is exactly what you want to see. But the real jaw-dropper is the balance sheet. It is a fortress. They are sitting on over $330 million in cash and liquid securities with zero debt at the parent level. That's not just a safety net, it's a war chest.
So really, what this quarter represents is the proof of concept. It's the first real evidence that management's new playbook is working. Acacia is no longer just a patent company, they're actively building an industrial and energy holding company.
And they haven't been shy about this. The CEO, MJ McNulty, laid it out pretty clearly. Their goal is to go out and find these businesses that are, a little unloved, a little beaten up, and undervalued. The plan is to use Acacia's cash and know-how to turn them around. This is active, hands-on work.
Now this kind of change doesn't happen overnight. You can see the key steps right here. It really started with the Deflecto deal about a year ago. That was the big pivot. Then they brought in a new CFO to really instill some financial discipline, and all of that led to this quarter, which is really the first big report card for the new strategy.
Okay, so everything sounds pretty amazing, right? But, and there's always a but with investing, this stock has some baggage. To get the full picture, we have to understand why the market is still in show-me mode and hasn't totally bought in just yet.
And this chart says it all, really. Over the last year, the S&P 500 is up a very nice 17%. Acacia, it's down 22%. That huge gap shows you there's a credibility issue here. It's going to take more than one great quarter to fully win back the market's trust.
So this brings us right to the million-dollar question for anyone looking at this stock. Is this quarter the real deal? Is it the beginning of a real turnaround that's going to get the stock re-rated, or is it just a flash in the pan?
Here are the main worries keeping investors on the sidelines. First, management isn't giving any formal guidance, and that uncertainty makes people nervous. Their new businesses also face some real-world headwinds, like tariffs and the natural cycles in industries like trucking and construction. And yeah, that old IP business is still there, and it's as unpredictable as ever. The bottom line for Wall Street is, they need to prove they can do this consistently.
All right, so we've looked at the pros, we've looked at the cons, now it's time to put it all together. What's our call? Let's get into our forecast for what happens next.
Okay, here are our numbers. For the fourth quarter, we're forecasting revenue to inch up a little to about $61 million, and we expect adjusted earnings to hit break even, basically no profit, no loss. Given the momentum and the strong asset base, we're setting a price target of $4.50, and we're rating the stock outperform.
And just to be crystal clear, an outperform rating means we expect the stock to beat the overall market averages over the next year. Our thesis is pretty simple. We believe the operational improvements are real, and we're betting that management is going to put that giant pile of cash to work, creating even more value.
So how would you think about this as a trade? Well, first, you have to see the valuation floor. The company has about $3.45 per share in cash and liquid assets alone. That's a pretty strong safety net. Second, you have to believe this quarter proved their M&A model works. So the trade is really a bet that management makes another smart acquisition in the next year. If they do that, the market will be forced to reevaluate the stock not as a pile of cash, but as a true compounding machine.
Let me boil it all down to the simplest possible terms. At the current stock price, you are basically buying the cash on the balance sheet, and you are getting the profitable, growing operating businesses for nearly free. Think of it as a free call option on a skilled management team that just proved they know what they're doing.
And that's our take on Acacia Research's quarter. As always, make sure you do your own homework. This is not financial advice.